In this chapter, we're going to be talking about private not-for-profit organizations. So in the prior chapters, we've been talking about public not-for-profits or governments. In particular, we talked about state and local governments. We talked about public colleges and universities. But now we're going to switch to private not-for-profit organizations. And the thing to know is that when you have a private not-for-profit organization, instead of using GASB, we're now going to start using FASB. Now, we can define a private not-for-profit in the following way. We can say that a private not-for-profit accomplishes a mission. They're in business to accomplish a mission or objective that is not profit-based. Another way to define a private not-for-profit organization is to say that their revenue comes from donations at large and from membership dues. This is very different from governments because when you have a state and local government, a lot of the revenue is going to come from taxes. For example, property tax or sales tax. So with a private not-for-profit organization, now we have revenues that are being derived from donations from the public and also from membership dues. Some examples of private not-for-profit organizations include things like the American Red Cross or Guiding Eyes for the Blind. Okay, so those are just a couple of examples. So we can say that a private not-for-profit organization is a not-for-profit organization that's going to generate essentially three types of financial statements. So even though it's not called this, private not-for-profit organizations are going to have something that is basically like a balance sheet, an income statement, a cash flow statement, and perhaps if they are a voluntary health and welfare organization, they might have a fourth financial statement. This is called a statement of functional expense. So what is a VHWO? A VHWO is a private not-for-profit organization that promotes the general health and welfare of the public, and they get their support from voluntary contributions. So a voluntary health and welfare organization, an example would be the American Red Cross. What about if you have like a sorority like Delta Gamma? So Delta Gamma would not be a voluntary health and welfare organization. Okay, so we'll talk more about this a little bit later in the lecture video. But for now, I want you to know that private not-for-profit organizations have to file 3 or perhaps 4 financial statements. So we have a statement of financial position. This is like a balance sheet. Statement of activities. This is like an income statement. And a cash flow statement, which shows cash inflows and cash outflows. And again, if you're a voluntary health and welfare organization, you must file a statement of functional expense. Okay, so these are the basic financial statements for a private not-for-profit organization. So what we're going to do is we're going to take a look at this handout here. So we looked at this handout in a prior lecture, but I'm going to scroll down, and this is on page 4 of 6 on the document. This is for a private college and university. Okay, so a private college and university and a private not-for-profit are the same thing. So the 3 financial statements are, we'll go back here, statement of financial position or balance sheet. Here's an example of a statement of financial position. This is a balance sheet. So you have assets, liabilities, and net assets. Okay, and then of course assets, you have current, long-term assets. Liabilities, you have current liabilities, long-term liabilities. And then this is very important. For net assets, you have 3 kinds of net assets. Unrestricted. Unrestricted means that you can do whatever you want with the money that you have. You have temporarily restricted. Temporarily restricted means that there is some kind of time or use restriction. And permanently restricted, that means you can't spend the money at all. Typically, a permanently restricted net asset is like a permanent endowment. A permanent endowment is when a donor gives money to an organization, and that money has to be invested forever, and earnings on that money can be spent, but the principal itself cannot be spent. Okay, so here is an example of a statement of financial position. Next, we have a statement of activities. This is like the income statement. So let's take a look at the next page here. Statement of activities. So you can see here we have revenues and gains here at the top, and then you have expenses and losses at the bottom. And notice that we have multiple columns here. So we have revenues, gains, expenses, losses from unrestricted activities, temporarily restricted, and then permanently restricted. Okay? So again, the distinction is that unrestricted can be used for whatever purpose you want. When you have expenses, they always come out of the unrestricted category. So look here at the expenses that we have down here. You can see that all of our expenses come from the unrestricted category. Temporarily restricted means that there is some kind of time or use restriction. So maybe we got a grant for $208,000, and that grant must be used to provide research in a certain field. Okay, so that would be accounted for in the temporarily restricted category. Notice that there are no expenses for temporarily restricted. Permanently restricted, that means you can never spend the money. Look at here, in this line, we have contributions for $2.288 million. So that's probably a permanent endowment. So that money can never be spent. So it's accounted for in this column. There are never expenses that come out of the permanently restricted category. And lastly, if you're going to spend some money that's in the temporarily restricted category, look what happens. You see we have negative $1.525 million. So when you spend money from the temporarily restricted column, you have to take the money out of temporarily restricted. It goes into unrestricted. So you can see that these two numbers are the same, and then the money gets spent somewhere down here. So this is a statement of activities. The next financial statement is a statement of cash flow. So let's take a look at a statement of cash flow on the next page. So statement of cash flow, this looks like a statement of cash flow that you've seen before when you took financial accounting. We have three categories here: operating, investing, and financing. And for those of you that took financial accounting, you know that in the operating activity section, there are two ways to prepare the operating activity section. There's the indirect method and the direct method. Basically, the difference is that if you have the indirect method, you have to have net income. If you do the direct method, then you don't have to have net income. So this is a little bit tricky, but this is analogous to the indirect method because we have increase in net asset. That's basically like net income. Okay, so this is similar to the indirect method. Okay, so we have these three financial statements, and I want to talk about the fourth one. This one is optional unless you're a voluntary health and welfare organization. In that case, it's mandatory. A statement of functional expense is simply a more detailed income statement. But it's a more detailed income statement focusing only on the expense part. So let me show you how it would look like. Okay, so statement of functional expense. Statement of functional expense categorizes everything by operating expense classification and function. Okay, let me give you a simple explanation here. So let's say that we have salaries expense. And if we're a performing arts center like Strathmore, maybe we have salaries expense for ballet, salaries expense for the orchestra. Okay, so you can see that most of the time when you have salary expense, you just have one column, you have like one number. But now we break salary expense into ballet salary expense, maybe that's 100,000, and orchestra salary expense, maybe that's 112,000. So you can see we're providing more detail, and a statement of functional expense takes your expenses and breaks them out into more detail, more columns. So you can have a statement of functional expense that breaks all of your operating expenses out into program functions, organizational units, projects, object classes. Salary expense is actually an object class, okay? And then by function. So we have ballet, orchestra. You can have functional classifications, for example, instruction, research. Another column could be public service, academic support, so on and so forth. Okay, so I want to go over two more concepts, and then we can do some questions and wrap up this chapter. So first thing, special issues, contributed services. If you're a private not-for-profit organization, you rely on contributions or volunteer work from people from the community. And when you have contributed services, then you either are going to make no journal entry, so no journal entry, or you will make a journal entry. Now, you're going to make no journal entry if you're a private not-for-profit organization and people contribute, they volunteer for your organization, and these people are not skilled. So if you have people that volunteer or contribute their services and they're not skilled, so for example, people that come in and sweep the floor, or they help at a cookout and they help cook hot dogs, that's not skilled. Then, if you have people contribute services of that nature, you don't have to do anything. You don't make any journal entry. Now, what if you have contributed services that are skilled in nature? So, for example, in the notes here, we have legal services, tax services, contributed by an expert. And look at this, it says here that contributed services are going to be skilled and would otherwise have to be purchased. Okay, so let's say that a CPA comes to our organization and says, I'll do your taxes for you. Well, we have to do our taxes anyways, and we have to pay somebody, but we had a CPA do the taxes for us. This is considered to be skilled contributed services. What you're going to do is you're going to debit contribution expense and credit contribution revenue at the same time. Okay, and you can call it unrestricted. The reason why I call it unrestricted is because whenever you have an expense, it has to go in the unrestricted category. The other issue is that private not-for-profits generally are not in the business to generate a profit. Basically, when you receive contribution revenue or donations, you should ideally be spending all of that revenue by providing services or helping the community. Now, when is it okay for a not-for-profit to have a profit? Well, there are 4 examples. When you're trying to replace or expand equipment or facilities. So if you have some type of long-term goal where you need to buy a new building, or if you need to expand your current facilities and add more capacity, then you can generate a profit. That means that you have more revenue than you have expenses, so you're building up some cash. You can also have a profit if you're trying to provide working capital. That's another word for having cash. You can generate profit if you're going to retire debt in the near future, or to continue programs beyond the time frame when seed money grants are available. So basically, if you're trying to keep a program going for a longer period of time, and if you know that grant money may eventually run out, that would be an acceptable reason to have a profit. Okay, so if you look at the notes here, there's a bunch of multiple choice questions with the answers. But on this page here, I just want to go over a couple of things. So, statement of financial position, that's like a balance sheet. Statement of activities is like an income statement. Cash flow statement shows inflows and outflows. And statement of functional expense is mandatory if you're a voluntary health and welfare organization. Otherwise, it's not mandatory, but it's recommended. It's a good idea. Now, make sure you know that a statement of financial position has assets, liabilities, and net assets. When it comes to net assets, we have three kinds. You have unrestricted, temporarily restricted, and permanently restricted. For the income statement, you have revenues, gains, you have expenses, losses, and then again you have columns for three categories. Okay, so again you can see that here. Statement of activities. You have revenues and gains, expenses and losses, and then you have columns for unrestricted, temporarily restricted, permanently restricted. Okay, so the columns again are unrestricted, temporarily restricted, and permanently restricted. The cash flow statement, you have three sections. You have operating, investing, and financing. And then lastly, for statement of functional expense, make sure you know that this provides more detail regarding your expenses. And you provide more detail by program and function. Okay, program and function. So program and function in the example that we talked about here. So you may have ballet as a program, orchestra, and then you can have salary expense as an object here. So we're basically providing more detail. Okay, so in the notes here, there are a number of multiple choice questions. I just want to go over a couple of these, and please feel free to ask me questions if you have them. But let's go over a couple of these. It says temporarily restricted net assets are released from restriction. When does something change from being temporarily restricted and then becomes unrestricted? Well, B, as assets are spent for purposes intended by the donor or a time restriction passes. So if you get money and there's some kind of restriction on it, it becomes temporarily restricted. Then when you spend the money moves out of temporarily restricted, it goes into unrestricted, and then it gets spent. So number one is B. Let's look at number 4. It says in number 4, ABC Charities is a public nonprofit organization. During the year, ABC Charities received $500 in cash donations from an entity who specified that the money must be remitted to Zebra Charities. How should ABC journalize the receipt of $500? Okay, so ABC is getting money, but they can't do whatever they want with it. As a matter of fact, this money is not even for ABC. They have to give it to Zebra. Okay, so basically, they're taking money and then they owe the money to somebody else. So that's not going to be a contribution revenue. It's going to be a payable. It's a liability because you owe the money to somebody else. It's going to be a donation payable. So number 4 is D. What about number 5? Number 5 says, which of the following donations of services would most likely be reported as an expense and revenue? In other words, recorded. Okay, so if you look at the notes here, we know that if you have contributed services, you would make a journal entry if it's skilled. So skilled means that a professional is doing it, and if the professional didn't do it for you, you would probably have to pay somebody else to do it for you. So 5, it says that the answer would be D, a licensed architect who designs a new wing of a building for a synagogue. That would be an example of recording a contributed service. Okay, so that takes care of Chapter 10. If you have any questions, please let me know.